Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me for the segment, we have John Mass, President of Content Partners, for a behind-the-scenes look into the negotiations that are shifting the entertainment industry landscape. John, it's great to have you with us. Welcome to Trade Talks.
Nice to be here, Jill. Thank you.
You got it. How do deals come to fruition, and how are they negotiated and valued?
In my business, sort of deals come around a lot of different ways, a lot of relationships. I've been in the business for nearly 30 years, so it's a very relationship-driven business where people know me, know what we do. We essentially created this secondary market for film and television libraries and participation 17 years ago. So we've made a bit of a name for ourselves. So they call us up and just in constant contact with different gatekeepers who might have these rights.
What are some of the major trends in deal making? And again, how do you value them?
I'd say there's a lot of talk right now about back ends, profit participation or contingent compensation. That has been a way different types of talent, writers, directors, actors, producers have been paid over the years. And with the sort of growth of streaming lately, that has lessened to a certain degree. There is no real back end in those types of transactions. So I think there's more talk lately about bringing back the back ends as a way to compensate people, but also as a means to reduce the risk of the people who are financing these. So you're seeing a little bit more conversation about that. So we'll see what happens. It's sort of early stages, but back end compensation, the idea of talent sharing and profits have been going on since the 1950s. So there's a lot of back ends out there still, some profit participations in the marketplace to buy, trade, sell, whatever.
How do studios evaluate and assess their content libraries?
I can't speak for how the studios do because I think, that I'm not in the studio business, but I would say they probably look at their performance. They have a lot of metrics that they have in-house where they could see how many people are viewing some of their content. If it is shared with streamer, if it's a controlled, like captive streamer that many of these vertically integrated media companies have, they have a lot of data. They also see how things sell all over the world. And if things are selling, they're going to continue to sell well. They also can capitalize on things. So if Oppenheimer's a big movie right now, then I assume that Dunkirk and other movies made by Christopher Nolan are going to be hot at that point in time. So they're very creative in how they package things. They're very creative in how they sell things and how they use data to mine that information.
How is the Hollywood writers' strike impacting IP rights and content adaptation deals?
Well, right now, nothing's really happening. We're really at a standstill as far as deal making goes. There are, I assume, deals being made between rights holders, let's say someone like Mattel that owns Barbie and a studio like Warner Brothers. Those types of deals can go on right now where they're licensing that IP. But the idea of adapting that IP, hiring a writer and adapting that to make it into the movie that it became, that's at a standstill right now. But certainly with that success of Barbie, a lot of, and to a certain extent, I'd say to a greater extent, even Super Mario Brothers, that movie did extremely well. And I think a lot of companies are looking at IP, whether they're children's IP or toy IP, which in the case of those two, or gaming IP, and trying to mine it for greater value.
What forms of IP and content are most valuable, and what drives long-term potential and profitability? Does it go back to those gaming and children's verticals?
I don't know. I don't know if there's any one that is greater than the other. Look, books are great sources of IP, have always been. Magazine articles. Look at the success. Netflix bought the Roald Dahl estate a few years ago, and they're now making that into a movie. Willy Wonka is being made into, like, Timothy Chalamet is that's being made. I think it's going to be released later this year. And so there are a lot of sources for IP. And I think there's stuff that people, I think for years they thought about making a Barbie movie and they haven't been able to do it. But finding that right creative talent, and Greta Gerwig, they found someone who knew how to tell a story, believed in it, and did it in such a unique way. It attracted terrific talent, and they made a great movie out of it. So you never know where it's going to come from.
How and why is profit participation changing?
I think it's changing, well, to a certain extent, as I said before, the profit participation had sort of gone away from a streaming standpoint. As these companies became vertically integrated, they decided that they would rather buy out the profit participation going forward and pay people more upfront than they normally would to buy out their back end so that they could control, they meaning the studios or streamers, can control the distribution sort of within their own walled garden of the content. Now that's sort of changing as we see the walled garden sort of breaking down and companies like Warner Brothers Discovery selling content outside of their own ecosystem. So I think it's evolving. I don't know where it's going to land. My hope is, as someone who used to work with talent in a talent agency and is a purchaser of this profit participation, I hope that we go back to where talent is participating in the success. And I think it's best for the industry because you really tie the success of the content, whether it's a film or TV show, to the talent. And they, I think, are inextricably linked, but also incentivized to see its success.
So, John, if I understand it correctly, one of the biggest issues with the writer's strike is exactly that, right? They're getting paid up front, but then if I understand it correctly, all the money comes from the big distribution deals. If a streamer or studio buys it, the writer or the actor doesn't get it on the back end anymore because they've been paid up front. And because the landscape has changed with so many consumers consuming content on streaming, that's really what the writers and actors are trying to figure out what their model looks like going forward and to be paid fairly.
Yeah, I think so. I think part of that is, I think it's a little less about back ends, but because during the streaming sort of growth that we've seen over the last 5 to 10 years, we've seen people be paid almost, I'm going to use this quote, I don't know who first said it, but I saw it somewhere, where you're overpaid for failure and underpaid for success. You have a show that only goes 2 years, you might have been paid more than you normally would get paid because your back end was bought out and it wasn't a huge success. But if you have a gigantic success and it goes on for years and years and it helps grow that streaming platform, you may not be seeing what you would have seen in a more linear world when you had a show like Seinfeld or Friends or The Office or Simpsons, and you had a back end participation and could share in the profits going forward. So I think a component of it is how you get paid. And I think the really focus is on residuals, I think is what we've talked a lot about, is should streamers be paying residuals for the airing of those shows? And that's something that they're trying to determine. But the back ends, again, the incentive, incentivizing artists, producers, writers, actors, directors, and tying their success to that of the streamer or studio, I think is a good thing. And hopefully that's how it ends up going forward.
Mm-hmm. What are the most impactful deals of 2023, and what do you think it means for the entertainment industry overall?
Wow. I think a lot of deals that were pretty impactful. I think the WWE being purchased and combined with UFC, that's a big transaction. The rumored potential acquisition of CAA by Keurig could be a really interesting deal and transaction. Warner Brothers Discovery, as I said before, looking outside their own ecosystem and selling their content is big. And I think what we're going to see going forward through 23 and into 24 is probably a combination of streamers. I don't think we see as many streamers as we have today. I just don't think that is going to be the case. And I think you'll see big media companies maybe combining too. There's going to be more consolidation in the business because just has to happen. And unfortunately, I think partially because of the writer strike, partially, just the cost of the interest rates are higher, but there are a lot of companies, smaller companies that are going to go out of business. And we're going to start seeing that too, unfortunately.
But from the consumer perspective, consolidation with the streamers and with the studios almost feels like how the cable industry felt a couple of decades ago. There's just so many of them, right? Mm-hmm. And I mean, it just gets expensive when you're paying $8 here, $10 here, $15 here. I think consumers might be welcoming to see some consolidation in the space.
I think so. As long as they benefit from, the programming doesn't change, right? They still have great high quality programming, the shows that they want to watch. I think consumers will be fine. Hopefully consumers win in the end. As a consumer, I cut my cord recently, and then I started looking at my monthly bill on my credit card, and I'm like, wait a second, now it's approaching my cable bill again because I had so many streaming services. And I think a lot of people are going through that decision, and there'll be some sort of cost benefit analysis. Do I really use this service or not? And do I really need it? Maybe I ordered for just this one show. And I think there's a lot of going on where people are going to order an app, because they'll use it like an app for one show, watch that show, and then disconnected. And I think that benefits the consumer, right? I'm not tied to that for the entire year. I can cut it at any time. I can get back on it when my show comes back on the air. And I think it's really good for consumers. And I also think the advent of FAST and AVOD, the growth of those channels, is giving consumers more choice with ads, right? Which is good for consumers too. So I think consumers are in a good place.
Yeah. All right, John, we appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.